for the webinar is about liquidity planning for SMEs. More importantly, how you as a business owner, financial accountant, or a CFO of a company can improve the cash flow of your business, and by that, improving the overall performance of your business. The agenda for today is to go through the problematic situation currently in Switzerland, introduce you to liquidity planning and a few terms and KPIs on how to actually do this. The next part is to define payment terms of your accounts receivables and your accounts payables and how you can improve these within your business. Last off, we're going to finish off with a Q&A sessions in case any one of you would have any questions. So to start with the problematic situation in Switzerland, what we have done is that we have spoken to multiple of our clients and asked them what is the most pressing problem for them today in their financial planning of their business. In addition to this, we have done some research and looked at some very thorough data points to actually get a better picture on what the general situation is in Switzerland. So to start off, when we have talked to a lot of our clients, we have realized that long payment terms is an issue across several industries within Switzerland. So for instance, it can be a problem with delayed payments, and that doesn't require that your customer is a badly shaped company. It can be any company that are delayed with their payments. So for instance, one of our customers is having trouble with governmental organizations that are in general very late with paying their invoices. They always pay them, but they pay them late. And this becomes a problem for this customer as it has a bit of a difficulty to actually plan the cash flow of the business. Another common problem is when the work is required to be done before you actually get paid by your customer. So for instance, among staffing companies, it's often the case that the personnel gets hired and they spend their hours at the client. However, the client first pay after the work is done. However, in the meanwhile, the company has to pay the salaries to the staff who are at the clients. So this becomes a mismatch in the cash flow, basically. A third big problem is basically having cash tied up in invoices. Sales can be going great. However, if you have the cash tied up in invoices and a new sales opportunity arises, it can be difficult to actually seize that opportunity because you basically do not have the cash that is required to either buy the raw materials or pay the salaries of your staff in order to seize this opportunity. And that's a common problem which we have seen among commodity trading companies, but also wholesale companies. So to look a bit more into the data, what the situation looks like in Switzerland, we can see that the average delayment of a payment today is 18.1 days. That means that after the due date, on average, it takes 18 days for a customer to actually pay their bill. If breaking it down to the different regions within Switzerland, we can see that there are some that are more affected of this and some that are less affected of this. But in general, differences are not bad. So if we look at the different cantons of Switzerland, we can see that it ranges mostly between 15 and 23 days in delayed payments. One might ask oneself, why is it that payments actually do get delayed? Well, if one customer pays his bills late, that means that you as a business might not have the cash in order to pay your suppliers in time. And basically this creates an effect along the whole value chain within your given industry. Another common reason why bills are paid late is basically lack in customer communication. So one might send an invoice to one's customer, however, that is easily misplaced or forgotten about. Why things like reminders or a clear communication before the invoice is going to be paid is a good idea. The third reason is long internal processes. In general, small and medium businesses do not have the financial resources in order to have a big financial department. And this often creates long internal processes among businesses. And that in turn means that sometimes invoices get paid late. The fourth thing is that the transaction process might also delay the payment. Things have to be cleared at the bank before the invoice is paid, and that results in delayment. The last reason is that Switzerland in general is a very exporting country. So a high portion of the sales or the customers are often international. And this amplifies all the problem above. The communication becomes more difficult, the transaction process takes longer, and it all results in more delayed payments. So we realize that in general, delayed payments is a common problem within Switzerland and especially within small and medium businesses. And this causes a big trouble sometimes for the businesses when they're doing their cash flow planning. Next, we're going to go in a bit more into liquidity planning. A few terms will be defined, but we'll also go through why it is important to work with liquidity planning and how you can do it more concretely. So working capital and cash flow are considered as the two most important issues when it comes to liquidity management. So to start defining what these terms actually means. Working capital can be calculated by taking your current assets, minus your cash, minus the current liabilities. And what a more general definition would be is that it is the money that is required in the day-to-day business of a company. Two things are interesting to look at here. Well, actually, three things. So in order to improve your working capital, you can either increase your accounts payable, you can decrease your accounts receivable, or you can decrease your inventory. So in general, what we want to do when running a business and doing the cash flow planning of a business is to decrease the working capital as much as possible. Because otherwise, your business will have cash tied up in accounts receivables and inventories. And this is cash that cannot be used to pay bills, pay salaries, or something similar. Another important part is the importance of cost and financing cost. So, by improving your working capital, you can strengthen your balance sheet. But if you do not improve your working capital, if it gets worse, well, then your balance sheet will get worse. And what implication does this actually have? Well, a worsened balance sheet results in a worsened credit rating. And that means that whenever you're seeking financing from a bank, for instance, you will have to pay a higher interest rate on that loan or the credit line. That is why it's very important to actually look at liquidity planning from a business perspective and from a financial perspective. So from the business perspective, it's all about being able to run your business and grow it to the maximum potential. From a financial perspective, it's all about decreasing your financial costs so you can get access to more cash and grow your business further. Another important thing is looking at the cash flow of the business. In general, one looks at the free cash flow, That is a very interesting term, and how it can result in excess cash, basically. So in order to calculate your excess cash within a business, you start off by taking your net profit and then you add the depreciation to it. Then you add the interest expenses, net of tax, that you have had throughout the year. Next part is to take the difference within your cash and cash equivalents, the difference in your accounts payable, and difference in inventories, and you subtract these from what you already have. Next part is to take the difference in your accounts receivables, the difference in accruals, and then you will have the cash flow from your operating activities. If you add cash flow from investments and cash flow from financing to this, you get the change in excess cash. And basically what one can say is that the goal is to increase the free cash flow of your business and optimize the use of the given capital, because this will make your business run better from a business perspective and from a financial perspective. The calculations of free cash flow can be done in multiple ways. So if you Google this, you will be able to find other ways to calculate it. But this is a way that we would recommend you to do. Two other KPIs that you should consider when thinking about liquidity planning is the cash conversion cycle and ROCE. So the cash conversion cycle is basically a term used from how long does it take you for ordering goods and the money that you pay into those goods actually converting into your customer repaying, your customer paying for the goods or services that they have ordered. So the starting point for the cash conversion cycle is when you order raw materials, for instance. So you order the raw materials, they get delivered, and once you actually pay your supplier, that's when the cash conversion cycle starts. The next part is that you do produce your goods and you deliver these goods to your client. The next step is basically that you send the client an invoice. And the invoice obviously do have a due date. However, as previously mentioned, it's very common that customers are late with paying their bills. So they might actually pay it after the actual due date. And this increases your cash conversion cycle. So what you want to do within your business is basically decreasing your cash conversion cycle. So a way of doing that is, first of all, by increasing your payment terms to your suppliers and decreasing the payment terms for your customers if possible. And another important KPI to look at is ROCE. It's basically a measurement of the efficiency and profitability of the invested capital of a business. I won't go through the actual calculations of ROCE, but you can find calculations of this online. What is interesting is that ROCE is basically a commonly used KPI when measuring the financial success of a business. And what we can see is that there's strong correlation between the cash conversion cycle and the ROCE, meaning that if you can decrease your cash conversion cycle, you can make your business perform much better. So for instance, when looking at the average cash conversion cycle, it's about 56 days. The ROCE of those companies was 15%. However, if looking at the best one in class here in the study that we have looked at, we can see that Pepsi, which had a cash conversion cycle of 20 days, had a ROCE that exceeded the other companies by 3 times as much. Hence, thinking about the cash conversion cycle is an extremely important element that you should do when running your business, either as a business owner, CFO, or financial controller. Next, we're going to go into the payment terms and what more concretely you can do in order to improve your payment terms with both your suppliers and with your customers. So there are three main points that you can use to start the improvements. First of all, you can shorten the payment terms on your debtor side, meaning that your customers have shorter time in order for them to actually pay the invoices. The next part is to prolong the payments on your creditor side, meaning that you will actually have longer time to pay your suppliers. And the last part, which we won't go through today, but which is an important part, especially if you're producing products, is to have a more efficient inventory management, meaning that you decrease how much products you have in stock at a given time. So if we look what you actually can do in order to decrease the payment terms of your debtor side. Well, first of all, it's a lot about organization. So basically that you organize yourself, that you have a clear definition of what the payment terms are and how you actually deal with sending out the invoices and actually getting your customers to pay. The next part is a credit line. So it is important to actually look at how long payment terms should I be giving to each customer. In general, one should take the approach to give shorter payment terms for new customers and maybe longer payment terms for customers that you have had a long-lasting relationship with. Because customers that you have had a long-lasting relationship with, in general, you know that they are going to pay you. Otherwise, they wouldn't be your customers anymore. The third action that you can take is communication. So here it's important to set up internal communication guidelines. When and how is the customer communication about payment going to happen? If those guidelines are clear, then both your organization will work more efficiently and the customers will know when you communicate with them. The fourth part that is important as well is to be proactive, and it ties in with the communication. So here you should be proactive in the sense that you get in contact with your customer before the payment is overdue. A short phone call can be considered as a friendly reminder, and the phone call can actually happen before the payment is due. So that means 10 days before your customer is supposed to pay their bill, just give them a quick call, ask them if they've been happy with your products, and just remind them that the payment is upcoming. Then it's an important element to be persistent. So be aware that there is a contract and the payment itself is an obligation of your customer. Some customers might stretch it and might give you different reasons. But if you feel that these reasons or excuses for not paying becomes too late, you shouldn't give up. You should be consistently reminding your customer of paying. That ties into the next point, reminders. Unfortunately, there are no ways. Companies will always be late with their payments, and that's unfortunately the situation that we live in today. However, by sending reminders, you significantly increase the chance that your customers will actually pay you and that they will pay you quicker. So setting up some clear guidelines on when to use reminders and when you send these out. Our recommendation is that you send them frequently to your customer. This will significantly increase the chance that the delayment will not be any longer. And as the last part, what you actually can do is pre-financing. So if you have invoices, there are alternatives to actually pre-finance your invoices. So for instance, what we do at Advanon is that we give you the opportunity as a business to upload the invoices that you have on our platform and financial investors can then pre-finance them. And you're able to do this from the first day when you send the invoice. So meaning even before your customer is supposed to pay the invoice, you can get access to the cash of that invoice. Next, we're going to look a bit more on longer payment terms on the creditor side. So here will be a bit of negotiations, which is important for you in your business. So when going into negotiations with your supplier, there are a few elements that are important. So first of all, you should mention that the increased payment terms will help to improve your financial situation. And if you improve your financial situation, your business will perform better and you will be able to increase the orders that you give to that certain supplier. Hence a win-win situation. The second argument is to emphasize the following topics. That you do have a seasonality of your business, meaning that in certain times there will be less cash on your account due to the fact that you have more work to be done during that time. Another part is to mention the long payment terms of your debtor side. So basically, if you have long payment terms on your debtor side, you will not be able to have very short payment terms on your creditor side. And also, a third point could be talking about the benefits of a long-term collaboration. So shortening the payment terms can be beneficial for both of you in the long run because you will be able to increase your business overall. Another point, which is sometimes commonly used, is to have a cash discount when paying the bills early. So basically that you will get a discount in case you pay the bill earlier than what is set out in the terms. Then there are some things to think of in general of your organization when improving the efficiency. So with the innovative accounting softwares, you can significantly improve your internal processes and efficiency when actually making payments to your suppliers, but also when getting paid by your customers. In terms of efficiency, in case you'll always receive your invoices in hard copy, you can use the scanning software in order to improve the handling of invoices. By having everything digitalized, you will be able to work more efficient with your accounts receivables and your accounts payables, because you will be able to organize it on your computer instead of in a physical way. Last but not least, it's important to try to keep all of your processes as simple, automated, and standardized as possible when dealing with your payments. So that's everything for now. In case any one of you have any questions, I would be happy to take them now. So I got a question here. What are the costs if I would like to pre-finance my invoices through Advanon? The cost will depend on your credit rating. And in general, what we can say that a company pays for pre-financing is the invoice is between 0.5% up to 3%, depending on the credit rating. If we have another one. Another question that we got is, what if my debtors are very conservative and shouldn't know about me using alternative financing? So is there any other solutions to get access to liquidity? Well, when using Advanon, we will not get in direct contact with your customer unless you allow us to. So we basically give you 3 different alternatives. Either you can provide us with additional documents that prove that an invoice is valid, you can allow us to call the customer. But in case we call your customer, we will basically do it from a customer satisfaction perspective. So we will ask them if they're happy with the goods or the services that have been delivered, and if everything is okay according to the invoice that has been sent. The last alternative is that we send a similar framed email that we basically ask if they're happy with the services provided and where they can confirm that the invoice is valid. So these three options basically is a way for us to verify that an invoice is valid, but we ensure that your customer is not aware of your financing solution. So by using Advanon, you can basically get paid quicker, you can improve your cash flow, and you can do it in a very easy way in which your customers are not aware of your financing setup. That seems to be everything for today. I would like to thank you everyone for attending this webinar and hope to see you in one of our other webinars. Thank you very much. And in case you would like to get in contact with us, here you can see our contact details. We would be very happy to talk with any one of you about how you can improve the cash flow of your business, no matter if you want to use our services or not, and to hear your insights on what problems you have as a business owner. Thank you very much, and I wish you a very nice day.